Good afternoon from Singapore. It is 4 p.m. here at DBS Asia Central. I'm Taimur Baig, Chief Economist at DBS Group Research, and with me is Ma Tieying, Senior Economist. Hi, Tieying.
Hi, Taimur. Good to be with you.
Tieying, normally we do these things with 3 people, sometimes somebody connecting from Hong Kong. Today, it's just you and me. So it should be a more streamlined than usual presentation, and it won't be as hectic. We both will have plenty of time to go over our material. As always, we have a setup for you, which is the QR code to ask questions, which Tieying and I will take during the course of this presentation. And if you can't scan that QR code because you're watching it on a mobile or something like that, well, then you can just go to dbs.pigeonhole, pigeonhole.at, and then enter the passcode macro April 24. If I have gone over that a bit too fast, don't worry. We will come back and give you this information several times through the course of this presentation. So the outline, very straightforward. I think that there are a bunch of things that are happening at the macro front that should make us think about certain troughs or inflection points. Normally these things don't happen all at the same time, but we think that we can probably put together several thematics around that, and hence the title of today's presentation, Time to Shed Complacency, because there are a bunch of things happening on the trade cycle, on the inflation cycle, even big, long-standing thematic of China being an underperformer. We think that there is a potential inflection point there, as well as with commodities. So we will talk about that. Tieying will talk about regional trade, as well as what's happening at the investment side around the China Plus One dynamic, which remains a very compelling narrative in the global landscape right now. So with that in mind, let me get going. Firstly, the issue of sticky inflation. Now, this is causing quite a bit of consternation in the marketplace. If you remember our live streams toward the end of last year, November or even December, when we did the annual outlook, and the subsequent few weeks even after the outlook, all the way through the middle of December 2023, markets were busy pricing in substantial economic slowdown in 2024, substantial rate cuts in 2024. And all of that was predicated upon the assumption that inflation, or rather the battle against inflation, is more or less done. Disinflation trend is going to entrench itself through the course of 2024. The Fed will be comfortable with that, and it would also see significant economic slowdown, not just price momentum, but also jobs and income-related slowdown. And as a result, by March of 2024, rate cuts will begin in earnest, and I believe at some point in the middle of December last year, the pricing was for something like 175 basis points in rate cut in 2024. Well, all of that has been upended in a fairly dramatic manner in the span of just a couple of months. And the primary reason for that is the fact that inflation is not following the expected script. It is heading into, or it has come into much more comfortable territory than it was in 2022 or for most part of 2023. No doubt about that. Any which way you slice it or dice it, headline inflation, core PCE, or even trim mean, everything is much lower than they were during the post-pandemic environment of supply chain disruption and then subsequent war-related issues in Ukraine. But having said all that, the path toward 2% is turning out to be bumpy. We had thought that there was some risk. We didn't think that that risk would manifest so quickly into the cycle. So for example, when you look at the inflation momentum gauge, which we calculated as 3-month over 3-month seasonally adjusted annualized inflation rate, well, that peaked at the headline level, about 10%, at the core level, around 4%, or others, 8%. But since then, the path has been somewhat steadily, coming down until recently. Until recently, the journey from 10 to 5 to 4 was pretty straightforward. At the core level, the journey from 8 to 4 to 3-ish was also pretty straightforward. But then, in the last couple of months, we're basically seeing the inflation momentum sort of begin to flat out. In fact, if you think about what's happening with core inflation in the US, we see that the inflation momentum actually rising already, which will probably show up in the actual data in the coming months. Meaning further disinflation at the headline or the core level in the coming months, March, April, May, data as they become available, may not be that straightforward. The story is still largely a US-centric story. When we look at data out of Europe, there the deceleration in inflation momentum is far more discernible, and we do think that now the risk is that the ECB actually ends up cutting even before the Fed. And as far as Asia is concerned, whether it is headline CPI or core or even food price inflation, still in very benign territory. I don't think there is a risk of policymakers in Asia preempting the Fed. I think that's unlikely given the nature of the capital account, the carry trade, and perhaps even not that tremendous amount of urgency for a rate cut. But at the same time, I don't think there is a chance that Asian central banks would have to hike or give out hawkish signals either. Inflation is not a big issue so far, and waiting for the Fed to cut and cutting at that point, I think is okay. I don't think there is any major growth or employment risk anywhere in Asia right now that would cause central banks to want to preempt the Fed. That is, I think, something that only the ECB can contemplate for the time being, not the rest. What else is happening on the inflation side, especially if we think about forward-looking indicators? So what you're seeing on the screen right now is the ISM manufacturing price. So this is a survey-based data. People who sort of take part in ISM surveys, the manufacturers, they're asked what's happening to their pricing environment, particularly with respect to input prices. And as you can see, the response has turned around. The response eased very dramatically from 2022 all the way to 2023. But in the last months of 23 and the first 3 months of 24, we have seen respondents who say that there is some incipient price pressure, that number beginning to increase. Not in any way at an alarming point. It's just that it's not going down any further. That's the whole point of this discussion. We are not presenting the sticky inflation slides to argue that we have a big spurt in inflation or a rapid rise in prices just around the corner. Nothing of that sort. All we're trying to argue is that the journey toward 2% inflation is turning out to be bumpy. It's not that inflation is heading to 4%. And as that bumpiness becomes evident across a wide range of prices, it would cause some degree of pause for the Fed before it embraces a wholesale rate cutting cycle. So now, where is this pace of disinflation moderating? Probably not on the good side, although I will talk about commodities momentarily. But as far as food prices, energy prices are concerned, still in fairly benign territory, although at the pump level, U.S. petrol prices have been rising a little bit, but it's more of a bottoming out story than anything else. The areas where there's far bigger concern is what is known as the super core part of the inflation, the services side, what's happening to insurance rate, medical insurance, car insurance, home insurance, what's happening to rental, recreation, dining, travel. So the things that make up the modern economic life. Modern economic life devotes less and less proportion of expenditure to essentials, but more to discretionary spending. And that's where we're beginning to see still some impetus for prices to go up. Supply of labor in the service industry is tight. Demand for services, whether it's travel or tourism or a broad range of other things, still pretty ample. And as a result, we're seeing that bumpiness in core inflation, or stickiness, if you will, manifest as the months go by. I think we would need a palpable slowdown in hiring and wage growth before this part of inflation starts to become subdued. Short of that, I really don't see the supply side with respect to labor improving in a very dramatic manner. I also don't see businesses finding excuses to, or rather not finding excuses to raise prices. They'll keep on saying, I can hire labor, I have to pay them a lot, and therefore I have to increase the menu price, insurance price, rental price, et cetera. So around that narrative, as I alluded to earlier, that there has been a major rethink on where is the Fed going to go with respect to its rate cut narrative. Now, we have been writing about and following closely the Federal Reserve, and what we see is that from Chair Powell onward, there are a lot of senior officials in the Fed who are speaking bravely about the fact that recent evidence of stickiness is not a big deal. Overall fight against inflation is proceeding in a satisfactory manner, and inflation is heading toward their medium-term target of 2%. No worries, and there will be room for a rate cut at some point this year. When we look at the median forecast of Fed FOMC members, what we see is that they are more or less split between 2 rate cuts this year and 3 rate cuts this year. The market is still grappling with that will the Fed will do 3 or would it end up doing 2? And I think that's a bit of a 50-50 coin toss right now. I think recent communication from the Fed, which is that there's no hurry to cut rates, is an important one. They want to cut, but there is no urgency to cut. There is no sign of economic slowdown. There is no sign of financial market distress. We're not seeing liquidity tightness becoming a big problem. If any of those things were taking place, I think a narrative about the need to cut some rates as an insurance policy would begin to take hold. But I don't think the U.S. economy is giving the Fed any data point to show any such urgency whatsoever. So as you can see, the very dramatic change in market pricing at some point, in late 2023 or even very early 24, we saw the market pricing in 6-7 rate cuts through the course of this year. That's now all gone down to less than 75 basis points. And for 2025 as well, the pricing is just about hovering at 75 basis points. So we're talking about a shallow cycle. Typically, when economic slowdown begins, recession worries surface, the Fed's cut by a lot, 300, 400, sometimes even 500, 600 basis points if they have the room. In this cycle, the Fed has the room. Fed funds rate is at between 5.25% and 5.5%. If we genuinely thought a recession is around the corner, we would be pricing in far bigger rate cuts. If there was genuine conviction that around the narrative of weak growth, inflation is going to collapse very, very soon, we would again see substantial pricing in of large number of rate cuts in 2024 and beyond. None of that is part of the narrative right now. Expectation is 5.5 might be a bit too high. The Fed may want to take it down to 4-ish, and hence that 150 basis points or so of rate cut narrative for 24-25 in place. So the higher for long narrative remains intact even in a rate cut scenario, meaning the terminal rate, the neutral rate, is not as low as previously thought. The Fed may not be able to take rates down to, let's say, 2% or something in the foreseeable future in this forthcoming years. We are talking about a cycle where rates go to, maybe about 4 by the end of 2025, and then perhaps somewhat a little lower in 26. But that, again, depends on deep recession or substantial financial instability. None of that seems to be on the cards right now. Now, we as a bank have been maintaining a rather unchanged forecast for a very long time. I think since September of last year, we've been saying that 100 basis points of rate cut will take place in the second half of 2024. Now, this seemed very, very hawkish in late last year, early this year, when the market was pricing in 175 basis points of rate cut this year. Now it seems rather dovish. Well, the market has gone down to 50 to 75 basis points while we're stuck in 100. I think the wisdom of not touching the forecast over the last 6-7 months is self-evident. We didn't join the zeitgeist when the market was pricing in too much. We're not joining the zeitgeist now when the market is sort of losing all conviction of rate cuts. We will keep an eye on this. I think a couple of more months of sticky inflation data will probably force our hand to change the forecast and have slightly more modest outlook for 2024 in terms of rate cut. But there's a lot going on in the economy, although right now there is no sign of labor market cooling. 2 more months, who knows what's going to happen between now and May, June. And same with inflation. Right now, we're talking about sticky inflation narrative. But if labor market were to cool, some of the service side inflation momentum may dissipate altogether. And maybe we will have to then rethink the pricing. Or rather, the market would have to rethink the pricing. We just might get an excuse not to touch our forecast for even more months ahead. So that's where we are right now around that so-called sticky inflation narrative and the big rethink with respect to what the terminal rate and the neutral rate of the US economy is. To me, I have to be honest, I think we as economists have not done a very good job of forward-looking analysis on neutral rate or assessing the Fed cycle. Just like Fed officials, we are so-called data dependent. We are looking at the rearview mirror. If inflation looks high, we think inflation is going to be high going forward, and we change our view on Fed policy. If in a backward perspective inflation was low, we extrapolate that. For all the high-tech modeling and research that's gone on monetary policy and forecasting, we're unfortunately still very much sort of adaptive, if you will, with respect to prognostication. All right. The other point that I was making, that we need sort of growth-related dynamic to also ease up a bit if indeed we're going to become comfortable about disinflation, rate cut, and all of that. Well, that's not happening yet. For the first quarter, we just ended. As far as nowcasting models are concerned, U.S. will comfortably report over 2% real GDP growth, perhaps even 2.5%. That is pretty extraordinary given that we have had nearly 2 years of monetary policy tightening. And this is no longer a U.S.-specific phenomenon. At some point in 2023, the recession narrative was actually even more compelling for our euro area, where economic momentum was really coming to a grinding halt in the summer of 2023. Even that has turned around somewhat, and the European economy is no longer surprising on the downside with respect to trade, production, sales, and so on. I think there is room for a rate cut there, just like there's room for a rate cut in the US if the disinflation narrative becomes entrenched. There, I think it is a little more clear in Europe. They don't have the service sector tightness that the US is experiencing right now. So perhaps there is some hope there that even if the growth story is one of somewhat resilience, there might be some room for rate cuts there. Now, what makes this growth resilient dynamic? I think this is where we have to sort of bring in the role of the public sector. The private sector, of course, took the COVID shock with quite a bit of stride because it was getting substantial transfer from the public sector, both the US and Europe, or over here in Singapore as well. Substantial transfer, cash support for consumption, significant amount of employment support for businesses. All of those things certainly helped growth to turn around quite rapidly as the pandemic abated. But beyond that, the infrastructure tailwind that we're seeing around the world, or private sector enthusiasm for investment in artificial intelligence and broad range of tech that we're seeing around the world. And of course, with the developments in Ukraine, which has created a big sort of crisis of confidence in Europe in the defense establishment and expenditures being ramped up there, or what we're seeing in Palestine and Gaza, around that also, focus has gone back to ramping up defense capabilities around the world. So defense-related spending, infrastructure-related spending, technology-related spending, there is a lot going on, public, private sector as well, which is driving up an investment cycle, which certainly is helping the growth dynamic both in Europe and the US. And let's also not forget that since the pandemic, we have seen robust stock market and debt market rally, which again has led to substantial wealth gains. Property story is the same. Asset prices and properties, stocks, bonds, everything has led to a significant improvement in the balance sheet of households in the Western world. And that again helps confidence, that again helps the resilience of growth narrative. So all in all, that sticky inflation resilient growth narrative, I think warrants some degree of rethink about what's coming in the remainder of 2024 and beyond. Right now, the narrative is clear. What's coming is less number of rate cuts and a shallower monetary policy cycle. All right, so that's one story, big rethink. There's another story where there's some rethink required is China. I think it's been years since we have had rather one-way narrative on China. Property market distress is deep, financial sector is struggling, local governments don't have financing, trade and tech war is depriving China of market access, as well as next generation of technology. All that has been written and discussed ad nauseum. When we had the 2 sessions last month, immediate takeaway was, too little, too late. This is not going to help turn around consumer sentiment, property market sentiment, and so on. But when we look at the data, it doesn't seem that doom and gloom anymore. Even before I go to my slides, I think those of you who follow the stock market know that over the last 4 or 5 weeks, both the Chinese and the Hong Kong stock market have started showing signs of life. Similarly, when we talk about offshore bond issuance, so-called dim sum bond, RMB bonds issued in Hong Kong, the numbers have gone up a lot. This does not necessarily show some desperation to fund other debt obligations, but to my perspective, it actually shows a budding confidence among companies in China that they can now go to capital markets with renewed degree of confidence that they can get decent pricing that is necessary for their businesses or their financial management. So what are we seeing in China? Firstly, on the trade side, and again, Tieying will talk about this in much greater detail when her term comes, but I just want to show you that with respect to both the PMI as well as exports, China is not looking that bad. So we have here, this chart actually extends all the way through the end of March, although the scale suggests February. We have PMI. Again, manufacturing PMI has picked up. It's heading toward 51. And exports, after being in the doldrums toward the end of 2023, has sort of turned around rather handsomely and is now heading toward 5-6% on a 3-month moving average basis. So while the long list of to-dos remains long, there has to be a lot more work done on the property sector. There has to be greater clarity on the regulatory environment. China needs to keep its momentum on green transition, which is pretty impressive, but that needs to be not a 1-year process, but like a multi-decade process. And with all these tech restrictions coming in, needs to double down in developing homegrown technology, has to deal with aging, job creation is a big thing, consumer sentiment has to be turned around, and of course the overarching theme of geopolitics with US pushing back China in a relentless manner across a wide range of areas. So there's no shortage of things to make your head ache when you think about the challenges of China. But those are omnipresent. They were there 2 years ago. They'll be there 2 years from now. But within the construct of all those challenges, can the authorities support the economy in such a way to turn around animal spirits, consumer sentiment, get some asset market rally going? And I think the answer to that question is yes, they can do that. Not only because trade is beginning to help, but also because while the market is not particularly impressed, but the fact of the matter is policy is accommodating, unlike the West, where monetary policy is tight. Fiscal largesse has been so big during the pandemic that fiscal needs to tighten, whereas in the case of China, it's the opposite. Policy is progressively becoming more and more accommodating and supportive, and that will help, I have no doubt. So what is the evidence of that accommodation? Well, firstly, on the monetary policy side, over the last 6-7 years, faced with growth slowdown, faced with a huge amount of shocks, China has steadily reduced interest rates on loans, on deposits. Now, you could argue that this is bad for Chinese savers, that they're not getting sufficient returns on their investment in a safe destination, like a fixed deposit, or, if you will, or a government treasury bill. Well, given that inflation is extremely low in China, this is still providing real returns, so I would not worry too much about that. But more importantly, if there is indeed a secular slowdown taking place within the backdrop of a property market correction, this is the best practice. You do want to have accommodating policy in place without necessarily fueling a bubble or a rebound that is rather extreme. The authorities are also accepting that in a situation like this, a weaker RMB makes sense. So over the last few months, we've seen again the RMB beginning to adjust, and the fixing that has been done by the authorities on a daily basis, again, is allowing for this gradual adjustment of the exchange rate. Given that rates are so high in the US and the dollar has been so strong, RMB's slide against the US, to me, sort of makes sense, even from a fundamentals perspective, not just as a policy lever. Similarly, beyond the monetary policy stance, the funding rates for banks, when we look at 7-day reverse repo or other things where the interbank rate or the margin lending facility, in all of those areas, efforts are being made to have ample liquidity, lower cost of funding, so the economy can address not just the property market issue, but also other areas where there is some headwind. When we look at public sector support to the economy, proxied by the indicator known as total social financing, which is the total amount of credit that the economy is undertaking, we saw a welcome spurt, the highest we've ever seen, in fact, both nominal and in real terms, in the first quarter of 2024. I think this needs to continue, and I think it's also likely to continue, that more credit creation is the pipeline. So all in all, in China, the rebound is around policy accommodation, with, of course, a long list of well-recognized and well-understood headwinds that need to be tackled. But at the same time, that policy accommodation, in my view, should be supporting animal spirits, whether it is IPO of few Chinese brands or debt capital market work by Chinese companies. I think those things are all in the pipeline, which should, again, buoy sentiment to some extent. All right. The other area where we, again, talk about inflection point or rethink required is the area of equity markets. When you look at Asian equity markets, for example, it's a rather heterogeneous narrative. You've got Shenzhen, Shanghai, Hong Kong at record lows. I mean, when we look at average PE in this part of the world in the 2000s or even 2010s, the current PEs are much, much less. Understandable, again, a lot of shocks have hit Hong Kong and China in recent years, and profitability, returns, everything has been disappointing. So the market's valuation downgrade is understandable, but this looks like very cheap territory in my personal view. And I do think that those looking for value cannot ignore Chinese stocks, despite the large list of negatives that are associated with China these days. Opposite of this is the India story. Then when you look at even the go-go days of 2000, when India used to grow by 8-9% in real terms, and the nominal GDP used to expand by 15-18%, even in those days, Indian markets were not this expensive. So the tremendous optimism, in contrast to the chronic pessimism associated with China, the tremendous optimism associated with India is something that we have never really seen in Asia in a very, very long time. So Indian markets are exuberant. They're pricing in substantial growth, real and nominal, for years, if not decades to come. And as a result, we're seeing extremely high valuation by historical standards in India. What about the rest? Well, again, a bit of a mixed bag. Nothing is particularly cheap, although you could argue that India, Singapore, and Philippines offer value from a historical perspective, and then some degree of optimism beginning to build into Taiwan, perhaps even Thailand, which to me is very interesting given the perennial political issues afflicting that economy. What about outside of Asia, the biggest stock market in the world, the US? It's very expensive. It's not as expensive as it was during the big run-up in 2022, or rather 2021, when tech stocks were really going gangbusters. Although we have seen few stocks do extremely well around the AI theme in this cycle, overall, the run-up is still not quite at an all-time extreme levels. But whether it is slightly less expensive than it was in 2021, the fact of the matter is these are still significantly higher valuation than that were prevalent even before the global financial crisis. And we know what happened, how those valuations corrected. We had a massive bear market in the US in 2008, 2009. I don't think, short of a major financial market accident, a big bear market is around the corner. There are lots of secular themes in place right now. As I said earlier, investments around defense and technology and green transition is really changing the picture for companies to raise money, to deploy capital. And I think that is very positive, especially in the US, for the stock market outlook. But valuations are stretched without any doubt. That also needs to be taken into account. And especially when you see the second chart on this panel, the so-called yield gap, the gap between safe asset returns, proxied here by 10-year US Treasury yield and the S&P dividend yield. I mean, looking at that, you would not want to hold stocks. That you looking at that, you would say that I have significant amount of risk reward coming from the fixed income side than the equity side. Clearly, that metric is not being a good predictor of near-term stock market returns, because that metric would have told you to sell US stocks late last year, and you would have left a lot of money on the table because the market has gone strength to strength since then. So on the equity valuation side, I think the bottom line is that within Asia, Chinese stocks definitely look attractive from a valuation point of view, and we are seeing pockets in Asia where there's substantial amount of optimism, none more than typified by the Indian stock market. As far as the US is concerned, valuations are stretched, which probably means not necessarily a bear market around the corner, but perhaps some lackluster returns after the very handsome run-up in the last couple of years. Finally, on the commodity side, again, the general narrative is commodities are no longer a source of headache. We've seen heroic supply side response on energy. After the Ukraine war began, the West made the choice to divorce itself away from Russian oil. It was a very painful but a very successful transition. Europe has managed to wean itself away from Russian gas, consuming largely from the US and Qatar. And in terms of oil, also much more diversified source of supply for Europe. US, of course, is self-sufficient in energy these days and is a big exporter of energy and is playing a major role in the global energy complex. Okay, having said all that, the supply side is ample, and especially demand from China being lackluster sort of explains why commodity prices have been weak lately. Doesn't necessarily mean commodity prices are going to be weak for the rest of the year. Again, just like we argued in the context of US inflation, we're not talking about a major rebound in inflation. Similarly, on the commodities, we're not talking about a major rebound in commodities, but we are increasingly confident that the commodity prices don't have further downside left. Now, there's some anomaly in the commodity market. I mean, look at the first chart I have on this panel, which shows basically, when dollar is weak, commodity prices go up, and when the dollar is strong, commodity prices go down. And this net relationship held very nicely, say, from 2020 all the way to 2021. But since then, we have had a situation where the US dollar has both strengthened and weakened, and then strengthened again, during which time commodities have just secularly come down. So it's not just a dollar story. There are more things going on, as I said, on the supply side, very impressive responses. But the biggest anomaly of all on the commodity side is not energy, but rather precious metals. Gold at an all-time high, not at a time when safe assets are returning so handsomely. It doesn't make sense unless you start thinking it from the perspective of geopolitics, that all these wars and trade and tech war going on, weaponization of dollar probably does make even a zero-yielding asset like gold an attractive one, and maybe that's why it's been rallying. We could make the same argument for crypto, but that's for another day, another seminar. So on the commodity side, so we think that the last couple of months has been interesting. Just like China has begun to show some green shoots of progress and growth. Similarly, the commodity markets, when we look at the last, say, 6-8 weeks of data, crude oil, cocoa, cotton, sugar, palm oil, nickel, aluminum, copper, everywhere there's been a nice spring in the price dynamic, some rally taking place. And I think that it is reflecting two things. One, of course, is that fact that China seems to be bottoming out. But the second is also, while the supply side response has been heroic during the 22-23 reaction to the Ukraine conflict, it's hard to make the argument there is ample additional supply going to be added on gas or oil front in 2024. Hence, supply side somewhat inelastic, demand perking up. You put the two together, means probably we've had a trough in commodities and additional upside is in the pipeline. Not a massive one, but some. All right, so that's the sort of roundup of the 4 key themes that I want to talk about. Let me just finish off with a little bit of discussion on our forecast. Instead of giving you the full list of what is the expected growth rate, which is not that different from consensus forecast, I think I have on the slide right now tells you a better picture. Where do we see a growth pickup in 2024 over 2023? Well, not in China, where we think that growth from 5-ish last year will slow to 4.5. Perhaps we're being a bit too pessimistic. Maybe we need to think about that. But also in the US, Japan, Eurozone, everybody had a good 2023. Although 24 has started out well, we still think by the time the year ends, there'll be some weakness kicking in, which again will justify some rate cut in the second half of this year. But the area where we see upside to growth is the middle part of this chart. Wide range of ASEAN economies, from Malaysia to Singapore to Taiwan. Everywhere, the post-pandemic recovery has fully going to materialize actually in 2024, trade, domestic tourism, domestic consumption, all of that. As far as inflation is concerned, the red bar is 2022, the really, really striking big year when we had very high inflation. And since then, a gradual slowdown. As you can see in the US, we're not forecasting significantly below 3 inflation. It's still 3-ish. But generally speaking, I think central banks are breathing a sigh of relief that after all that high inflation of 2022, 23, 24 would be characterized by significant easing of price pressure. Maybe not all the way down to 2%, but decently. And finally, on the policy rate side, I've already talked about our US forecast. We still have that 100 basis points of rate cut, which would make it actually cumulative 75 basis points of easing if you think about from the perspective of the first half of 2023. But beyond that, no more than, say, 50 basis points of room for rate cut within Asia, whether it is Reserve Bank of India or Bank Indonesia, or for that matter, PBOC, very, very modest rate cut room left there. The only country where we see rates going up is, of course, Japan. And around that, we have a whole FX narrative that we do expect the yen to appreciate at long last. But generally speaking, 2024 ought to be characterized by policy accommodation in the major economies in the world. All right, I'm sort of done with my section. Let me now move on to Tieying. Tieying, all yours now.
Thank you, Taimou. So in the second part of the presentation, we want to take a look at regional trade as well as supply chain and the so-called China Plus One strategy. Ever since the end of last year, we have been calling for recovery in global electronic cycle, and this forecast so far has been doing quite well. Well, when we look at global semiconductor sales, and we can see that there are some typical cyclical patterns. Usually 2 to 3 years of expansion and 1 year of decline, and another 2 to 3 years of expansion. The latest expansion was between 2020 and 2022 during the pandemic. The lockdown during the pandemic has boosted demand for electronics devices and also boosting demand for semiconductors. And last year, as the pandemic came to an end, the lockdown-related demand disappeared. So the semiconductor sector also fell into a decline. And after this whole year of inventory adjustment, finally we see some sense of turnaround. Demand is picking up again, and inventory restocking is happening. If the historical experience continues to hold, then we may see another 2 to 3 years of expansion in the semiconductor cycle, which means from 2024 to 25 or even 26. In addition to the cyclical factors, we also see some fundamental drivers that comes from the new technology innovation, particularly the AI technology innovation. According to forecasts from Bloomberg, the generative AI market will have very strong growth potential in the coming decades. The annual growth rate will be more than 40%. And by 2032, the size of the generative AI market will reach $1.3 trillion US. Strong growth rate will happen across all the major segments, from hardware to software. Many of the electronic devices we use today, like computers, mobile phones, they need to upgrade to install the AI function to improve the user experience. The infrastructure, such as the servers, the cloud storage systems, they also need to upgrade to expand the capacity to enable AI training and to enable a large amount of data storage. Semiconductors demand for the high performance logic chips, high capacity memory chips will also increase very strongly in the coming years. Well, Asia will be a very important beneficiary for the electronic cycle recovery because Asia is the largest electronics manufacturing base in the global market. So in Asia, we have China specialized on the the downstream, doing the computer, mobile phone production. We also have the relatively mature Asian economies like Singapore, Korea, Taiwan. They specialize on the upstream, doing semiconductor electronic component production. So within Asia, indeed, we have seen very clear sense of trade data turnaround. Export growth, for example, in Korea and Taiwan is already accelerated to around 10% year-on-year, already reversing the sharp declines in 2023. And China, ASEAN, if we look at export growth, they also return to growth territory and ending the contraction in the whole year of 2023. Manufacturing PMI are very similar patterns. Korea and Taiwan last year, manufacturing activity was in contraction, but recently their manufacturing PMI has started to turn around, almost returning to the neutral level of 50. China, ASEAN, we also see some moderate rebound in manufacturing PMI in the recent 1 to 2 months. We want to take a closer look at Korea and Taiwan. These two economies, they should be very important beneficiaries of the global semiconductor recovery. Korea specializes on the memory chip production. It accounts for about half of the global memory chip market. And Taiwan specializes on logic chips. For the global chip foundry market, Taiwan has a share of around 60 to 70%. And in these two economies, we indeed see very significant improvement in semiconductor indicators. Korea's semiconductor exports production, for example, have already achieved 50% year-on-year growth, fully reversing the decline in 2023. Taiwan will have the electronic components overall exports and production. These indicators they are also picking up, also returning to positive growth. Well, this week there is an earthquake happening in Taiwan's east coast. Currently, there are some reports about the temporary production suspension by the major semiconductor companies, which are located in the west coast. But we don't see major damage to the semicon manufacturing facilities in Taiwan. And today, actually, major companies, they have largely resumed production. So this earthquake disaster, we don't think it will change the outlook for semiconductor recovery. Well, we need to point out, in fact, the recovery in electronic sector, in semiconductor sector, currently remains incomplete and uneven. Well, taking Taiwan as an example, although the final demand is picking up, production is also picking up. In fact, the capacity utilization has not yet fully normalized. So when we look at Taiwan's capital goods indicators, capital goods imports, semiconductor equipment imports, in fact, they remain sluggish, still falling very sharply on the year-on-year basis. Another phenomenon is this semiconductor recovery. In fact, it's uneven across different product categories and across different markets. For the case of Taiwan, the recovery mainly happens for the advanced chips, the chips below 7 nanometer. But for the relatively mature technology node above 7 nanometer, in fact, the recovery is relatively lagging. Market-wise, we can also see that recovery is mainly driven by demand from G7 markets, from emerging markets out of China. The semicon demand from China, in fact, remains relatively weak. That is probably due to the weakness in China's consumer markets, probably also due to the U.S.-China tensions, the U.S. restrictions of the advanced chip supply to the China markets. So to summarize here, well, we indeed see Asia's trade cycle is turning around. Semiconductor, electronic sector is recovering. However, fundamental side, the improvement probably remains relatively slow, relatively lagging compared to the stock market performers. So between the investor expectation and economic reality, there is some gap, and this gap needs to be closed going forward. We now move on to the longer-term topic, which is about the global supply chain restructuring and the so-called China Plus One strategy. we have been emphasizing that the global supply chain is undergoing some kind of structural changes because of the geopolitical risk and also because of the natural disasters and the COVID pandemic. Well, if we look at the global geopolitical risk index, and we can see that the level apparently is higher than the historical average. Last year, there was the Middle East crisis, and the year before, there was the Russia-Ukraine war. These events have elevated the global geopolitical risk. Meanwhile, we also see natural disasters, pandemic disrupting the global supply chains. For example, the 2011 Japan earthquake and tsunami that has disrupted the global automobile production network, causing the shortage of auto components. And the pandemic, COVID pandemic between 2020 and 2022, that's caused a very serious disruption on global supply chain, from manufacturing to transportation to logistics. The impact was across all the major sectors and across all the major markets. So in response to the geopolitical risk and in response to the natural disasters, the major companies, in fact, they need to diversify their supply chain, diversify their production and sourcing locations in order to increase the supply chain resilience. In terms of supply chain restructuring and the so-called China Plus One strategy, we believe ASEAN is an important beneficiary. Here we have a chart showing the sources of global imports. Then we can see that, in fact, the share of ASEAN countries has increased significantly, especially Vietnam. Vietnam's share in global imports market has increased from 0.5% in 2010 to almost 2% in 2022. It's a very clear uptrend. And other countries like Malaysia, like Indonesia, we also see their shares in global import markets on the rise. Another chart here we have is showing the manufacturing locations of Apple's major suppliers. And we can also see that ASEAN, in fact, is becoming more important in Apple's supply chain. Vietnam, for example, currently there are around 25 companies located in Vietnam. They are in Apple's supplier list. And that's compared to around 20 companies 3 to 4 years ago. And in addition to Vietnam, we also see, for example, Singapore, Thailand, Malaysia, India. They are also gaining a more important position in Apple's supply chain. So some implications for investors. As ASEAN is benefiting from the China Plus One strategy, there are more foreign direct investment inflows into the ASEAN region. This should help to support the longer-term growth outlook in the ASEAN region. And more FDI inflows, further trade expansion, that probably will also support the external balance of the ASEAN countries and providing some support for their currency stability in the longer term. And interestingly, it's not only the global major companies adopting the China Plus One strategy. In fact, the Chinese companies, they are also adopting the China Plus One strategy. They are also actively investing overseas. Here we have a chart showing China's major outward direct investments, the so-called ODI destinations. Then we can see that China's ODI flows to ASEAN have increased very strongly from around $4 billion in 2010 to $19 billion in 2022. And ASEAN has already surpassed Europe, surpassed British Virgin Islands, also surpassed US to become China's largest ODI destination, if excluding Hong Kong SAR. Here, we also have a table summarizing the major investment cases by the Chinese companies in Southeast Asia in the recent 1 year in 2023. And we can see Chinese companies, they have been very active in Indonesia, in Malaysia, Singapore, and Vietnam. One major area Chinese companies invested is the manufacturing sector. They actively invested in Indonesia's metal and mining sector, for example, to access the important mineral resources and to produce EV batteries. And in Malaysia, in Vietnam, Chinese companies actively invested in automobile sector, electronic sector, to assemble cars, including EV cars, and to assemble electronics devices. Singapore here, Chinese companies focus on services sector. They actively invest in e-commerce, retail trade, logistics, and also real estate. That is to penetrate into the domestic consumer market in Singapore and also to the broader ASEAN region. Well, this China Plus One strategy, in fact, also offers China and Chinese companies some kind of benefits. Well, when the Chinese companies invest in South Asia, they assemble the finished goods in South Asia. At the same time, they also import the raw materials components from China, from the parent companies based in China. So the Chinese investment in ASEAN, in fact, is also driving the trade flows between these two regions. If we look at China's trade balance with the major ASEAN countries, we can see that, in fact, China has trade surplus with the majority of ASEAN countries. That includes, for example, Vietnam, Thailand, Malaysia, and Philippines. And the size of the trade surplus, in fact, has also widened in recent years. So from this point of view, we can see that, in fact, China and Chinese companies, they remain very important participants in the regional supply chain. Although some of the manufacturing work transfer from China to Southeast Asia, but Chinese companies, they continue to actively participate in the regional and global supply chain. Chinese companies, they can also enjoy some benefits from the China Plus One strategy. Well, by investing in Southeast Asia, Chinese companies, they can access to the growing consumer market in Southeast Asia. The growth rate of the consumer market in South Asia, in fact, has already started to outperform that in China. So it provides a new source of revenue growth for the Chinese companies. Meanwhile, the labor costs in South Asia are relatively cheap compared to in China. So that also provides cost saving for the Chinese companies. And ultimately, this will be reflected in companies' corporate earnings. So here, maybe also some implications for investors. Well, for the investors look at China markets, probably they can take a closer look at the Chinese companies actively implementing the China Plus One strategy, successfully implementing the China Plus One strategy, and to identify some potential investment opportunities. So this is the end of my part. I think we still have a few minutes. I will pass the time back to Taimo for questions.
Very good, Tieying. I will put the first question on the screen. It's actually for you. Okay, by the time it comes to the screen, let me just read it to you, Tieying. Which ASEAN country is likely at risk if U.S. switches to a Trump presidency?
Yeah, it's a good question. I think under Trump's term, if that is Trump 2.0, well, Trump probably will impose tariffs against the major trade partners, not only China, although Trump has already said he may impose 60% tariff on Chinese products. But in fact, he has also mentioned some kind of universal tariffs on all the major trade partners. So in Asia, in fact, we have many countries running trade surplus with the U.S., bilateral trade surplus with the U.S. So North Asia, from China, Japan, Korea, and Taiwan, in fact, they all have a large amount of trade surplus against the U.S. And within ASEAN, I think a country stand out probably is Vietnam. it has also large amount of trade surplus with the US, so it could be a potential target probably.
Do you worry about Malaysia, which has become very active in courting Chinese investments in the last few years, that they could also be in the crosshairs of the US?
Well, I'm not too worried about Malaysia. Actually, if we look at the Chinese investment into South Asia, if we look at country by country, currently probably it's Indonesia stand out. In terms of the percentage of Chinese investment in the total FDI inflows into ASEAN countries, Indonesia currently, I think China share is around 20%. China is already the largest FDI investor in Indonesia. So the over-reliance on China probably, I think it could be a potential concern for Indonesia, especially with the new government coming in.
Right, and also, I suppose we also have to think it through the lens of, who is taking advantage of the trade diversion. Because if it is for your domestic consumption and domestic mining industry and domestic auto industry, then of course, US tariffs are irrelevant. You're doing it for your own country. But like Vietnam, which has done a lot of trade diversion related stuff, I think the risk becomes much more palpable. There's another question, Tieying. This is a very intriguing question. Is the spurt in global investment in AI showing up in Asian trade and commerce figures?
Yes, I think we already answered in the presentation actually. So in terms of the high performance logic chips and high capacity memory chips, indeed we saw demand is rising and it's reflected in Asia's trade data, for example, in Korea's semiconductor exports, in Taiwan's semiconductor exports. But we also mentioned the recovery actually so far is not complete, it's not full-fledged. So the relatively mature technology node, the above 7 nanometer chips, in fact, the demand currently remains relatively weak. And for AI to spur the demand for end devices, such as mobile phones, computers, that will still take some time because we need innovation for the end devices to install the AI function. And for the refresh cycle to happen broadly in the electronic sector, I think that will still take some time.
Yeah, very good. Next question is for me. A tough one. Under which scenario the Fed won't cut at all in 2024? We can think of a few scenarios. Scenario number one is the recent pickup in growth momentum gathers even more momentum, and we start heading into the middle of 2024 with growth not only above 2, but heading toward 3. That would kill any chance of a rate cut because the economy is just way too hot. We will see the equity market rally, which again would turn into an easier financial market condition, which in turn would negate all the Fed's impetus for cutting rates. So that's scenario one. Second scenario is not growth, but just the inflation issue. The sticky inflation, as you heard during the end of my sticky inflation presentation, I was basically saying we're not talking about a big rebound in inflation, only a modest bottoming out of inflation. Well, what if that is wrong? What if we see commodity prices turn around? What if we see geopolitical situation, particularly around Ukraine, spill over into food and energy prices, which then leads to a big negative hit on expectations, and then going into an election situation, the Fed would be very, very constrained because it would be seen rather political if it cuts rate even as headline inflation goes up. So I think those are the two scenarios. One would be security-related spillover into commodity prices, and the other would be very strong real economic momentum building on to what we have seen already. Then, of course, no chance of a rate cut. And then, so Tieying, this question is almost the converse of the risk question. So which economies are likely to benefit the most from China plus one?
Yeah, I think we also answered during the presentation. Yeah, Vietnam, India, and maybe also Indonesia.
Right. Would you rank them? Would you put Vietnam number one in that ranking?
Yeah, Vietnam should be number one in the ranking. Yes.
Okay. All right. We are running out of time. I'll take one last question. Sorry, we had a few more questions, but cannot take everything on. Again, a really hard one. Which potential contagion risks are nobody paying attention to today? My fear is, given what's happening in the Middle East, the risk of terrorist incidents are rising, but it's not being factored in the energy markets or anything. So that's issue number one. Second is, as the year progresses, if indeed we see higher probability of a Trump victory, I think that geopolitical risk would spill over into China in particular in a negative way, and I think it could be quite seismic. And the third one is this commodity-related issue. Right now, the market is pretty sanguine. It may be a bit frustrated with the rate cuts not materializing, but it's also not particularly panicky about inflation upside. If that narrative were to turn, I think it'll be terrible for fixed income markets, perhaps even credit markets, and for the overall global economy. Fingers crossed, it doesn't have to happen. Maybe the market's wisdom is the best. That's it. Tieying, thank you very much for your help for this live stream.
Thank you, Tamo.
And thanks to our viewers. Take care, everybody. Stay healthy. We'll see you next month again. Goodbye.